another episode of the Federal Church Presents Better Than Bloomberg. We are in another day of the banking sector collapse. Here's another good note from Zero Hedge. Nomura calls for rate cut at next FOMC meeting, end of quantitative tightening. These banks are the first casualties of the Fed's tightening cycle. Historically, it's not really the Fed's fault. They should have fucking known better. They'll try to spin it some way or another. But historically, you can't raise interest rates by over 400 basis points in 1 year without breaking something. Big 1994, curvature securities. In the past year, Japanese bank Nomura has had a penchant for making several headline-grabbing outlier predictions about the Fed. Last June, Nomura was the first bank to call for a 75 basis point rate hike. View that quickly became consensus after the infamous Hilson-Rath weekend report that blew up the Fed's forward guide, followed 1 month later by an even more show-stopping forecast for a 100 basis point rate hike in July. Verdict, it got 1 out of 2 right. Former yes, the latter no. It's still not a bad track record when the bank takes the bold step to break away from the echo chamber herd. Which again, if you watch the Bloomberg stuff that I was watching yesterday, all you see would be them repeating the same things over and over and over again. Contagion, it's contained to SVB, blah, blah. No, SVB is not the problem here. Dipshits are. But, there were also a bunch of things that they would repeat, like, this is not like Lehman, blah, 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 this is not... Yeah, it's not like Lehman. You got no excuse for this one. At least you would have had an excuse if you were at Lehman. Then 2 weeks ago, the bank did it again because with the Fed seemingly torn between keeping its 25 basis point rate hike cadence or expanding it to 50 basis points to give the tightening campaign a little extra oomph after the latest FOMC minutes found that a higher than expected few favored a 0.5% rate hike. Nomura's strategist Aichi Amemiya wrote that he expects a 50 basis point hike in March, followed by 25 basis points hikes in May and June as persistent inflation drives the Fed to a more hawkish stance. Alas, that particular outlier call didn't last long, because with everyone expecting tomorrow's CPI to be the most important CPI in history, and again, that one's a fudge number. Nobody cares. That's worse than Soviet data. Point is, if you are holding these bonds and you're holding it to maturity, there isn't a chance in hell it's going to be worth anything that it's worth now in real dollar terms, or what you were expecting for it at maturity in real dollar terms, especially with the things that you have coming in your economy and geopolitical situation. And one which would cement if we get 25 or 50. Again, this doesn't matter. They need full on 20% fucking rates. Well, what is 50 basis points? It's nothing. Something unexpected happened, the shocking collapse of all crypto-friendly banks. And I love how they tried to spin that too. That is not a crypto, those are shit coins. That's how they should address it. Shit coins. It serves no real purpose. They're shit coins. So, collapse of those banks is again probably a good thing. It's just like the zombie bullshit startups that don't actually produce anything, don't actually have any revenue, sure as hell don't have profits. It shouldn't exist. And it's just like these dipshits who run these banks. If you manage to fuck up one of the easiest or most obvious trades on earth, probably in history, you should go under. This is not a failure of, any regulatory, people or any regulatory agencies. This is not a failure of, auditors doing whatever. This is a failure of dipshits at their jobs at the bank. and the one bank catering to Web3, courtesy of Liz Warren, Pocahontas, who told regulators that to ignore potential bank bids. What is that? Yeah, who would buy this shit? You buy the management's fuck-ups, which they should not have fucked up because they're fucking idiots. As foot markets on their head in line with our forecast from 2022 that this hiking cycle would end in tears when the Fed breaks something. It wasn't exactly the Fed. In this case, the regional bank system. But trying to break the economy is that you always break the market first. Well, the economy's been gone for a while now. Quickly realizing that he needed to make a stark impression with yet another super outlier call after Goldman broke the seal last night when it said it expects an FOMC pause in March. Nomura's Amamiya decided he has to do what he has done so many times before and quickly published the most controversial Fed forecast yet, going from 50 basis points to negative 25 basis points at the negative FOMC, increasing 50 basis points to reduce 25 basis points at the next FOMC meeting, thus becoming the first on Wall Street to call for a cut to Fed rates at the next FOMC meeting. Well, that's the thing. Damned if they do, damned if they don't. So why a rate cut when merely calling for a pause seems controversial enough? JPM's Michael Feroli is still calling for 25 basis points hike. Well, as MME explains in his note, available to pro subs on Zero Hedge, while the Fed launched several bailout policy actions, all discussed there, which were significantly more aggressive than Nomura had expected, regulators expanded the scope of the emergency measures to protect depositors of Signature Bank. Again, depositors. Not bondholders, not equity holders. Depositors. And even then, they're writing checks they can't cash, which had amounted to much less than SVB. We think this suggested the strong intention of the regulators to prevent a similar episode with other banks and contain contagion. Again, it's not contagion. It's not one bank going under because of, well, I guess it technically is when they hedge their fuck up. If they were smart enough to hedge their, wrong way bets on rates, that's their contagion. And that one's going to get interesting. In addition, the Fed's new lending facility will likely mitigate the risk of small banks selling holding assets and incurring capital losses. However, as we also first noted, Nomura admits, judging by the market's reaction, financial markets seem to view these policy actions as insufficient. Oh, shit. Yeah, just the failure of depository institutions, just the deposits part is insufficient. Now take a look at their fuck-ups and see how on earth anybody, or try to explain to me how anybody on earth will want to be the one holding the bag with that as an equity holder or shareholder, or debt holder, bond holder. Oh, and again, knowing that you probably don't want to have your deposits in those institutions. So one market concern, according to Nomura and Zero Hedge, is that a deposit flight might not slow anytime soon for a number of reasons. Despite the FDIC's protection of all depositors of SVB and Signature Bank, corporate depositors are still concerned about a loss, even temporarily, of access to their deposits from the banks going under conservatorship. Which again, of course, is a huge fucking problem, because the whole point of it being a demand deposit is that it's available on demand, even if they are made whole later. Second, ironically, the sensitivity of individual depositors to deposit rates might have increased due to the FDIC's announcement of making all Silicon Valley Bank's depositors whole. We could see a significant outflow from commercial banks, which may compel banks to liquidate their loan portfolios, which again, fucked up, unless banks raise their deposit rates substantially, which again they won't do because nobody will put their money there. Third, on bank securities investment, unrealized capital losses in the bank's held-to-maturity portfolio might not become an imminent issue because of the Fed's new buy the fucking pivot. However, if the Fed keeps the policy rate higher for longer, banks would be averse to liquidating security holdings for for which selling would realize losses in securities anytime soon. And that's the important part, where, at some point, they are going to have losses. Even if they don't realize those losses immediately, at some point, they will. And who's going to be dumb enough to be the bag holder for it? Maybe those shit fucks who went on Bloomberg. Talked about being fucked up. But aside from that, I don't know who. Putting it all together, Nomura now expects the Fed to cut rates in 25 basis point increments in the March FOMC meeting in comparison to where we had previously expected a 50 basis point rate hike since 24 February, well before Chair Powell's testimony last week. Bank adds that although a 25 basis point rate cut seems unlikely to be a panacea for financial institutions, if the Fed shows expected continued rate cuts, a summary of economic projections, fucking shit, done. Markets could quickly price in further rate cut. This could somewhat reduce the risk of further bank runs. Probably not. Because again, you don't have anything here but a bunch of dipshits who went the wrong way on a trade, but it just so happened that trade is what capitalizes their banks. It's the bank's reserves. So they essentially fucked up the bank's reserves, which are your deposits. So, again, I don't know who would be dumb enough to leave their money there too, especially when you can see this stuff, by the way. Unless you might be one of those shit fucks that were going on Bloomberg to try to either bullshit or you actually are that dumb. There's more. The Nomura strategist also expects the Fed to stop quantitative. Oh, damned if they do, damned if they do. Also echoing out observation that small banks are now reserve constrained. Oh, again, like I said, when they fucked up, the one very simple thing, just the one fucking task they had, is to maintain their reserves and buy the most plain vanilla products there. They fucked up their reserves. You had one task to do, and you fucked it up. And it's quite possibly the easiest shit you could possibly do, too. You deserve to have your bank go under. What the Fed does, that's a whole different, well, it's not a whole different story. It won't make a difference. Damned if they do, damned if they don't. Amamiya says that although the choice of deposits versus non-deposit investment vehicles such as money market funds matters for banks, ending QT should help the amount of reserves more ample than they would be otherwise. Not if they fucked it up. The fact that other banks are facing a serious bank run, which again, everybody can see it, and if you see their reserves were dipshitted, you should probably, or you would logically assume that these people would remove their money from those banks. Because otherwise, they get to learn what fractional reserve banking means. Suggests an increasing risk of over-tightening by the Fed, which also supports a rate cut in the near term. As we argued, the cumulative rate hikes are disproportionately reducing the supply of credit through bank loans relative to financial market conditions. The lagged impact of past rate hikes can now materialize in a draconian way. We believe a tightening of financial conditions through bank loans could potentially steer the economy to a recession starting in. Shit. Where do you start with this? Well, first of all, they're in their mess to begin with was because of loose monetary policy and negative interest rate policy and all that shit, fucking cheap money and inflation. But yes, there is a recession. It never went away. It's still there, and it'll still be there. However, the process might be accelerating, potentially moving forward a resurgence and exerting disinflationary pressures with some lag. At this point, the Fed could become more forward-looking in a sense that it might put more weight on the inflation outlook. Yeah, that'll be the day. Watch, you'll see that bullshit CPI number bullshit and God knows what when, they printed trillions of dollars. As opposed to waiting for realized inflation to come down materially. That's not gonna happen. Actually, I take that back. Maybe if everybody drops dead on the projected timeline that the Reverend prophesized, that could be the case. In this regard, although we expect a solid 0.4% month-over-month core CPI inflation in the February CPI report on Tuesday, 14 March, we think financial stability risks are quickly becoming a dominating factor for monetary policy. While Nomura is still in the camp that a recession can still be avoided if only the Fed cuts enough, we will show momentarily that, according to Deutsche Bank, today's market action confirms the recession has already started. Oh, there you go. Another good note there from, I guess that was the important stuff from Nomura there. The plumbing stuff, the market stuff, that should get interesting too. I mean, I saw somebody mentioning that on Bloomberg last night, and they were understating it a little bit. You'll see the cascade soon enough. But that was a good note for Nomura there, from Nomura.